After the biggest stock market debut in ages, with Coinbase coming public at a surprisingly enticing valuation, the stock opened at $381, nearly $100 below the high end of the price range, and then pulled back, giving you an even better entry point. It's the perfect time to circle back to last year's most important deals to see what went wrong and what could go right. There was something tragic about the IPO market in 2020. You had a host of fabulous companies coming public. Yet Wall Street was so addicted to turbocharged growth stories that, for the most part, the prices, they were too high, often way too high. I try to keep an open mind on questions of valuation, especially when we're talking about disruptive technology plays with spectacular financials. But some of these price-to-sales ratios, well, they got unconscionable. Time after time, I give you the same refrain. Great company, bad price. So try to get at a lower level. I know I was sick of it myself. While that caution sometimes makes me look like a clown, at least initially, the IPOs from the class of 2020 have spent the last couple of months rolling over, which is exactly what I was most worried about. If you listened to me and you kept your powder dry, this market's now giving you the chance to buy them at lower levels. So is it finally time to pull the trigger? Or should you keep waiting for additional downside now that these former high flyers have gone out of style on the Wall Street fashion show? Let's take a look at last year's highest profile deals one by one. Many of these may have really stung you, but that's okay. We got to face facts here. We're going to go over the highest profile deals that I chimed in on. And we're going to start with nCino. That's little n then big C. You've seen them one twice on the show. Now, nCino is a provider of cloud-based banking software. There really isn't any other product like that. It's backed by Benioff. On its first day of trading last July, nCino surged to $91. I told you, too expensive. The next week, I recommended waiting for a pullback below 68 before pulling the trigger, then watching horror as it zoomed to 104 6 weeks later. But then the stock spent the next 6 months working its way lower, ultimately bottoming at $57. That was last month. And you know what? That was your buying opportunity. Since then, nCino's rebounded to the low 70s in the wake of a great quarter. After speaking to the company several times on the show, now you have got my blessing to dip into it right here. But there's no rush. And I wouldn't put on a serious position until it retreated to the mid-60s. But their stuff works. Banks love it. Next up, Snowflake, the phenomenal data warehousing play with a tremendous triple-digit growth rate. This one was a wake-up call because last September it started trading at 100 times sales. I initially urged caution. Then I got more comfortable with the valuation later in the year, before telling you to ring the register at $300. And that was back in January. Well, now Snowflake's at $229. That's down $25 from where it opened on its first day of trading. Some of that's due to the rotation. Some of it's because there's no more lockup on insider selling. I'd love to get more bullish on Snowflake, but it's out of step with this market. So why not wait for it to pull back to just 50 times sales, which would put the stock at $190, where I would. Also in September, the name sounds dumb, but the company isn't. Jfrog came public. Now, this is a software developer. I was adamant this one was way too pricey from the get-go, when it was trading at $64. Jfrog's now at $52. The valuation is a lot more reasonable at these levels, but again, there's no rush with these software stocks. I'd like it even more, below $43, or 20 times sales, which is roughly in line with last month's lows. Remember, these are sales, not earnings. They're expensive. All right, now next up is Amwell, the telemedicine play that came public around the same time. When it was trading in the low 20s, I told you to keep your bat on your shoulder because a bet on Amwell was a bet that COVID's sticking around for longer than expected. I thought it'd be more enticing in the high teens. Initially, though, the stock had a phenomenal run, making me look like a dope. Hey, what doesn't? But as the great reopening trade's gone into full swing, well, this thing's lost more than 2/3 of its value. Even down here, even at $17, I'd stay away from Amwell because it's too much of a lockdown stock. Then there's GoodRx. That's one of these things I use a lot. The fabulous prescription drug comparison tool that can save you a fortune on your meds. Once again, I urge you to wait for lower levels last September. Since then, GoodRx has been kneecapped by Amazon, getting into the pharmacy business, followed by the rotation of the reopening stocks, and then a big lockup expiration, a triple whammy. You got my blessing to speculate in this one now that it's been knocked down to the high 30s. Yes, any pullback from here, I am saying... Bye, bye, bye! It's a buying opportunity. On the last day of September, we got a pair of direct listings, one of them being Asana, which makes work management software. This one's been a real roller coaster, but I didn't like the fundamentals last year, and you know what? I still don't. Can't justify paying nearly 18 times sales for a company with a 38% growth rate. No thank you. Of course, sometimes we're too conservative. Lemonade came public in July. I didn't give them enough credit for using artificial intelligence to disrupt the insurance industry, which needs some disrupting, believe me. I told you to wait for a pullback below 50, and that's exactly what we got 2 months later. After that, the stock took off, and while it's gotten crushed over the last couple of days, it's down 50% from its peak, it's still up from where it started trading. I love Lemonade, the company. Half the staff uses them. But they're losing tons of money. And the stock sells for nearly 50 times sales. Not earnings, sales. Can't justify paying more than $75 for this $89 stock. Now, maybe my biggest miss from the class of 2020 was Unity Software, which has a whole video game platform that they license to developers. On the first day, it closed at $68, and I wanted to wait for a pullback below 50. That pullback never came. Unity soared to 175 at its peak in December. It's been crushed lately. At 101, it's still a winner if you got in early. At this point, though, you know what? I'd rather own the newly public Roblox, which is profitable, unlike Unity, and trades at a substantial discount. All right, then there's the much-beloved Palantir, the surveillance and analytics company that did a big direct listing at the end of September. I told you it'd be worth buying below $10, and then the stock went to 9 and change on the first day. But that was still a pretty guarded recommendation. This thing became a meme stock like GameStop or AMC, jumping to 45 at its peak in January. Since then, it's pulled back to around $24, though. What do you do with it? I think it's too much of a black box to get a real read on the business, so be careful. I feel a lot more confident if it pulls back below $20. Finally, we need to talk about Doordash and Airbnb, which came public in mid-December. Again, I hesitated. Told you I liked them in the double digits, but I misjudged the appetite for both of these stocks right out of the gate. They've both been in the triple digits ever since they started trading. At this point, they've both come down substantially, though, from their highs. I'm not really interested in Doordash here. It's a lockdown stock with too many competitors. I talk with them about my restaurants, but not here. Now, I am a huge fan, though, of Airbnb because it's a reopening play, and long-term, it's a true disruptor of the lodging industry. Still, Airbnb will soon be hit with a big lockup expiration, meaning lots of insider selling. Stock's currently at 175. I'd start nibbling if it came down below 157 and then back up the truck. If you can get it closer to 117, that would be a gift. The bottom line, though, it's hard not to chase these red-hot IPOs right out of the gate, isn't it? But as we saw from the class of 2020 and from Coinbase today, you'll often get a better price if you're patient enough to let them pull back a few days, few weeks, or even months later. Stay with Cramer.
Coming up, should home gamers be wary about too much of a good thing? Cramer's got a clear-eyed SPAC analysis to help you pull the signal from the noise. Next. Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.